I will be looking at the one thing that needs to be, whatever is at the beginning of the regulation, there needs to be some way to actually check whether the companies implement that beyond a mere investigation if catastrophic failure occurs, and that's the audit system. Since my background is building regulations to combat the finance of terrorism in the financing industry with governments and private industry, I thought I'll have a look and see how comparable that is with what we're doing in the financial industry, which, as you may know, is one of the most heavily regulated industries. So the first quick outline of the audit system, I'll do this very quickly just to show how it is supposed to be functioning, then a couple of lessons that we learned painfully with billions and trillions of dollars lost over the last couple of years that could be thought about to implement, and then a couple of suggestions on what further could be done to strengthen the position of the auditors. So how does this all supposed to be functioning is outlined broadly in paragraph 28 of the DSA. You have annual audits, it's financed by the platforms. Audited is the DSA and the code of conduct. In brackets, I would just say that would be a disincentive to join a code of conduct if I'm a business person, if I am afterwards audited on it. There is, of course, an audit report that says that's what we've done, that was the targets, and here's the recommendations, and the platform obviously will have to implement those recommendations or find alternative measures and then say why. So these audit reports then go to the digital service coordinators in the individual countries. So far, so good. So far, so absolutely parallel to audits in other industries. Then you have a couple of auxiliary elements. Of course, the already mentioned risk assessment by the platforms. That will be the basis of any audit report, of course. And then the compliance officer here, very curiously, allowed to be a contractor in Article 37, and then the European Board for Digital Services is supposed to support the analysis of the national digital service coordinators of the audit reports if necessary. What happens when you have a negative audit finding? Of course, both the national digital service coordinator as well as the board can request additional audits, can even begin enhanced supervision, which means complete continuous monitoring of the platform, including additional audits. They can open an investigation, including monitoring, and the investigation, they can take statements and interviews. Strange that it doesn't mean that they can collect evidence. There is an imposition of fines, which is up to the member states to define, but up to the 6% that Mr. Nemitz already said. And then additional fines by the EU Commission if it's an enhanced supervision, including regular fines until the platform gets out of enhanced supervision. Again, so far, unremarkable, very parallel to what is done. If there's a risk to safety and life, a court, meaning retroactively, can bar access for a limited period of time. That's unlimited renewable, but strangely, even if it's a threat to life, the DSA doesn't say that there's a permanent barring of anything by any court order. So it has to be renewed all the time. So what are the lessons learned in the financial industry? And that's really three things: keep them separate, keep them independent, and avoid commercial interests or commercial dependencies. So first of all, direct payments. If you remember the 2008 scandal, there was a lot that caused the financial crisis, but also one thing was that investment banks paid for their ratings directly to the rating agencies, which created an unhealthy commercial incentives for rating agencies to rate CDOs higher than they would have done if they would have no commercial incentive, because the rating agencies themselves, among themselves, were in a commercial competition. So the direct payment from the one who's audited to the auditor creates a commercial relationship that can be risky. Therefore, one possibility would be to say, why not create a common audit fund? You pay in by the consumer to the size of your company, and then that audit fund pays the auditor. So keep them separate. The second lesson learned was the mandatory rotation of audit mandates. Enron wiped not quite as much out as later scandals, but quite a lot in the Texas economy. One problem here was Arthur Andersen being so intrinsically involved in Enron over so many years that they bought into the Enron stories, believed the fake companies that were set up overseas to hide losses, and therefore did not recognize the ensuing catastrophe that brought the company down in the end. Therefore, keep them independent. you need to switch audit mandates. On audit mandate, whatever the regulations will say, for a company size of Facebook is going to be very large, very lucrative for whatever audit company is going to do this. Therefore, they want to have this forever. However, that entails the risk of an N1 situation to develop. Therefore, on the financial industry, the German government, but also the UK government, the US government are thinking about mandatory rotation every 5 to 10 years. You need a couple of years, obviously, because it's very complex to audit. So there's also a learning process of the auditors involved, but you need to switch. If there's an unending mandate, you may have an Arthur Andersen love story with N1 to everyone's detriment in the end. Then keep, and this is one key learning of the Wirecard scandal, plus an unlimited amount of company you want to name in the past, keep the separate audit and consulting mandates. Because we are talking about very large platforms here, very clearly that is not going to be a startup who's going to be able to get the auditing mandate. It's going to be big companies who also always have consultancy services which are far more lucrative than audit mandates. Audit mandates at a certain point are a automated process that is always the same every year, but consultants mandates, that's where the real profit is made by any company. Therefore, if you are the auditor and the consultant, there may be an unhealthy commercial incentive to give a more positive audit result to get the next big consultant contract. Therefore, avoid commercial interests. A couple of extra points. So you can only regulate audit, of course, what you regulate and what you standardize. Clearly in the DSA, the formulations are deliberately open, and I got a couple of examples here, the risk assessment and for risk mitigation. That is okay for legislation, but that is so open that you need to standardize in order to make this operationalized. Now, there is, of course, Article 34 that says European international standardization bodies will do some voluntary standard setting for auditing. This is great. Question is, which one of the services would that be? Because social media companies have never been audited, and it's very different to audit a Facebook from a Opel or from a financial industry. So that's the first question. The second question, of course, is why not have, as in other industries, a middle step here? You have the regulation, which is very, very open in its formulation. Then you have a regulatory standard setting bodies in the financial industry. That would be the FATF and the European Board of Digital Service, who could be that role, which then says, okay, this is what the convention says, or this is what the United Nations Security Council resolution says, and here is what we as governments agree what this means in operational regulatory terms for the governments to implement them. And then you have the private industry setting the standard. So there may be a charm in setting a middle step. A couple of minor points, of course, you can always discuss very large platforms, whether 45 million users is too big or too small, 10%, because you do have smaller platforms that can have a very harmful impact very quickly. So maybe a system relevant formulation may be the way forward here. In the DSA, curiously, when you talk about the audits, there's absolutely no guarantee clause except in the preamble, that auditors actually have access to all necessary information in order to do this. And one can have a very long discussion whether they can actually have the ability to audit this effectively, social media. But if they don't have guaranteed access to information, you have a guarantee that they won't be able to audit this effectively. And then my last point is really, don't give the impression that it's compliance by afterthought. The financial industry, with all its failings, always talks about compliance by design. If you make the compliance officer of Facebook a contractor, and no one in the higher echelons are going to listen to him versus the vice president, who's a former minister and is a full-time employee of Facebook. So in the internal hierarchy, DSA, as with all other audit systems that I'm aware of, locates the compliance officer with a direct reporting line to senior management. In order for that reporting line to be heard, a contractor is not a really useful setup here. So that is just unusual to allow this, and it may just a pen stroke and the problem is solved. All right, so this is my last point I wanted to make, and this is what we want to provide. that you have a nice audit system, and then the company says around your desk, you can order, and I'll do left, right, and center what else I want to do. Thank you so much.